right now, on paper at least, global energy looks surprisingly cheap. And, emerging markets look incredibly safe.
Yeah, they really do.
Like if you just glance at the mainstream financial dashboards today, you would honestly think we are entering this golden age of geopolitical calm.
A complete illusion.
Exactly.
Yeah.
Because if you peer beneath those surface numbers into the actual, physical data, you will find 15 Asian countries quietly begging for $4 billion in emergency cash.
Right.
Just to keep the lights on. Welcome to this deep dive. Today we are cracking open a really fascinating stack of macroeconomic dispatches from mid-June 2026.
And there's a lot to get through here.
There really is. And the overriding theme our sources are pointing to is something called the guidance vacuum. So, okay, let's unpack this. We are exploring the massive, highly dangerous gap between what global markets assume is happening and the chaotic, unscripted reality unfolding behind the scenes.
What's fascinating here is the underlying vulnerability. I mean, the market's complete over-reliance on scheduled, highly publicized calendar events.
Right, like the neatly organized meeting dates.
Exactly. Traders and institutions are staring at these meeting dates, assuming those dates actually dictate reality. Meanwhile, they're just ignoring severe disruptions happening entirely off the calendar.
Yeah.
Critical events ranging from, an emergency room in Jakarta to a quiet hospital bed in Tokyo.
Wow. Well, let's start with the grand illusion that's currently masking the energy sector. Because the surface-level metrics are painting this absolute masterpiece of tranquility, right?
Oh, for sure.
Oil recently hit a 3-month low. We're also looking at the EMBI Global Diversified Index, which, for those who don't trade sovereign debt daily, is basically a benchmark that tracks the debt of emerging market countries.
Right.
And it's sitting near 237 basis points, which essentially means investors are demanding very little extra compensation for risk.
You feel totally secure.
Exactly. It implies they are not worried at all. And the catalyst for this feeling of safety, the sources note, it's a comment from former President Trump suggesting the U.S. is close to an Iran deal.
Yeah, that's the trigger.
And just to be completely clear, we are not taking any political sides here or endorsing that view. We're just impartially reporting on how the market reacted to that specific political statement.
Right, we're just looking at the mechanics. And the market saw that headline and essentially priced in regional peace.
Which is wild. It feels a bit like throwing a massive celebration for a promotion just because you saw a vaguely positive, unread email from your boss.
That is a great way to put it.
The market is RSVPing to a wedding.
Yeah.
Before the couple is even engaged. They've decided the problem is solved.
But it is a remarkable leap of faith because the sources are very clear on this. The market is pricing in a complex diplomatic handshake that simply hasn't occurred.
Right.
They are trading on the assumption of de-escalation based entirely on a single statement while treating it as a finalized treaty. And when we look at the actual intelligence in these dispatches...
The paper reality is completely detached from the physical flow of goods.
Exactly. The physical reality tells a very different story. While traders are celebrating that all-clear headline oil price, the tangible supply shock from the ongoing Hormuz disruption is actively tearing through supply chains.
Yeah. Let's talk about the Asian Development Bank.
Right. The ADB just confirmed that 15 Asian countries have initiated requests for $4 billion in emergency energy support.
Wait, okay, I'm looking at these ADB numbers from the sources, and it contradicts the headline completely.
Completely.
If oil is supposedly sitting at a comfortable 3-month low, why is there a sudden multi-billion-dollar panic from 15 different countries just to secure basic energy needs?
To understand that, you have to separate global paper demand from local physical costs.
Okay.
Crude oil prices are down globally, largely because Chinese import demand looks weak on paper, right? And that drags the big headline number down.
Got it.
But simultaneously, China's domestic factory gate prices, like the actual cost for manufacturers leaving the factory, are rising at their fastest rate in nearly 4 years.
Because the physical cost to route a tanker through or around the Strait of Hormuz is inherently more expensive, regardless of what the global demand metric says on Bloomberg.
Exactly. The physical route costs money. So if you are a manufacturer, your actual fuel costs are spiking, and you have to pass that on.
So that's the transmission mechanism.
Yes. The global price ticker reflects a lack of buying appetite, but the domestic reality reflects a live, ongoing supply disruption.
Wow.
The energy shock is still pumping inflation straight into the world's second-largest economy and cascading into all those frontier nations, even while the trading screens flash green.
So the market is essentially blind to a massive physical inflation shock.
Yeah.
Because they are just sort of hypnotized by a generalized headline ticker.
Hypnotized is the perfect word.
And if you are ignoring hidden inflation, it stands to reason you are also entirely missing the central bank panic currently brewing across the global south. Which leads us to the chain reaction happening in Indonesia. If energy costs are secretly spiking, that drives inflation, forcing central banks into a really tight corner.
And Bank Indonesia is proving that the scheduled calendar is an illusion. They just delivered an off-cycle emergency rate hike specifically to halt a collapsing rupiah.
Let's contextualize an off-cycle hike for a second, because central banks are famously bureaucratic.
Extremely.
They have their scheduled meetings mapped out months in advance. To break that schedule and just hike rates out of nowhere, that is a severe move. It signals deep institutional fear.
It is the ultimate defensive reflex. Our sources detail how Jakarta has faced 3 consecutive weeks of compounding pressure.
Yeah.
First, they suffered a major export monopoly distortion. Then the data confirmed their trade surplus hit a 6-year low.
Ouch.
And now they are bleeding foreign investment capital amidst domestic political headwinds and market uncertainty regarding the incoming Prabowo administration's fiscal plans.
And again, we're remaining strictly neutral on the politics of the Prabowo administration here. The financial markets aren't judging the politics. They're just reacting to the sheer volatility and the uncertainty of future government spending, right?
Exactly. It's about the uncertainty. Indonesia is in full defensive mode, and India is caught in a similar current. Their own central bank is actively defending the rupee, which is a move corroborated by an FT view calling for emergency market measures.
Okay, but here is where the logic seems to kind of eat itself for me.
How so?
If a central bank hikes off cycle, isn't that basically them hitting the panic button in plain sight? Like, if I'm an investor, seeing the central bank panic doesn't make me want to stay. It proves to me that their scheduled calendar is entirely too slow to handle whatever crisis they are secretly fighting.
You are identifying the core paradox of currency defense, which the IMF actually classifies as a textbook risk-off scenario for shallow FX markets.
Let me pause you there. Shallow FX markets. For those of us not staring at Bloomberg terminals all day, does shallow basically just mean low liquidity?
Yeah, exactly.
Like a small pool of water, where one person jumping out creates a massive volatile wave.
That captures the mechanics of it perfectly. When a currency market lacks depth, meaning there aren't massive volumes of buyers and sellers at all times, any sudden exit of foreign capital causes the currency's value to swing wildly.
Right.
So when a central bank in that scenario hikes rates to defend their currency, they're trying to offer higher yields to incentivize that foreign money to stay.
Make it attractive.
Right. But the mechanism of doing so drastically raises domestic refinancing costs.
They make borrowing money infinitely more expensive for their own local businesses and citizens.
Yes. They compress private credit. They essentially choke their own domestic economy just to build a wall around their currency.
That is brutal.
It is. And the tragic irony is that they're doing this exactly as foreign investors are rushing for the exits anyway. It triggers a self-reinforcing tightening cycle.
Right, because the act of defending the currency makes the domestic economic situation look so fragile that it accelerates the very capital flight they were trying to prevent.
Precisely.
That is a terrible position to be in. Indonesia and India are in this massive, painful defensive crouch. They are hurting their own domestic growth just to survive the week.
Yep.
And here is where it gets incredibly tense. Because they are doing all of this before the biggest financial shoe even drops.
The Tokyo situation.
Exactly. The actual earthquake detailed in our sources isn't happening in Jakarta. It's happening in Tokyo.
The Bank of Japan. This is the structural shift the consensus is completely misjudging right now.
Let's lay out the facts for everyone. On June 16th, the Bank of Japan is scheduled to lift their policy rate to 1%. Now, if you're used to U.S. or European interest rates, 1% might sound microscopic.
It sounds like nothing.
Right. But for Japan, a nation that has lived with negative or zero interest rates for a generation, 1% is monumental.
It alters the fundamental arithmetic of the global financial system, specifically a mechanism known as the yen carry trade. But the sources reveal an absolute bombshell about this upcoming meeting.
Yeah, the variable isn't the rate itself, is it?
No, it is the sudden absence of the person scheduled to deliver it.
Governor Kazuo Ueda, the head of the Bank of Japan, has been hospitalized.
Right.
He is going to miss the single most important BOJ meeting in decades. So his deputy, Shinichi Uchida, inherits the lectern.
And that is a huge problem.
To understand the gravity of this, Think of it like trying to land a plane in a hurricane. We all know the plane has to land. That's the 1% rate hike. The market knows it's coming.
Right.
But the veteran pilot is suddenly out sick, and the co-pilot has to guide the terrified passengers over the intercom without causing a stampede. It's not just about hitting the runway, it's about keeping everyone in the cabin calm while you do it.
If we connect this to the bigger picture, the market expects the 1% hike. What it is terrified of losing is the communication premium.
The communication premium.
Yeah. When a central bank executes a monumental shift in monetary policy, forward guidance, the specific phrasing, the tone, the nuanced reassurance provided by the leader is literally the only thing that keeps the market orderly.
Because the market isn't just reacting to the math, they're reacting to the bedside manner. They need to know the central bank is in total control.
Exactly. Without Governor Ueda there to provide that carefully rehearsed forward guidance, the tail risk of a sharp, unguided spike in the value of the yen skyrockets.
Wow.
The market abhors a vacuum, and an absent primary communicator is the ultimate vacuum. If Deputy Uchida sounds even slightly more aggressive or, slightly more hesitant than expected, the algorithmic trading models will violently overreact.
Okay, let's break down why a sudden, unguided spike in the yen is so catastrophic for the rest of the world. Connect this to the yen carry trade for us. Why does a communication fumble in Tokyo threaten the global south?
Okay, so the yen carry trade relies on a very simple premise: borrowing money where it is virtually free and investing it where the returns are high.
Right, basic arbitrage.
Exactly. For decades, investors and entire nations have borrowed heavily in Japanese yen because the interest rate was at or near zero. They took that cheap yen, converted it, and bought higher-yielding bonds in riskier developing countries.
Wait, so if I'm a sovereign nation like Pakistan, Egypt, or Ethiopia, I might fund my national infrastructure or my deficit by essentially borrowing cheap Japanese money,
Yes.
just banking on the assumption that the yen will always remain cheap and stable.
That is exactly the case. It's been a safe bet for a long time. But if Deputy Uchida steps up to that podium, flubs the communication, and the yen's value suddenly spikes upward, the math of that trade violently reverses.
Oh, no.
Yeah. The debt those frontier nations owe just became massively more expensive in their local currency terms. It triggers an abrupt unwind. Investors rush to dump those emerging market bonds to pay back their suddenly expensive yen loans.
So an awkward press conference in Tokyo instantly metamorphoses into a sovereign debt crisis in Cairo or Lahore.
It creates a massive, immediate funding shock. The cost to refinance national debt for these frontier countries skyrockets overnight, and it's completely outside of their own central bank's control.
And man, let's bring these dual threats together. Because the picture our sources are painting is a classic pincer movement.
It really is.
If you are a finance minister in one of these developing nations, or even just an investor holding emerging market bonds, you are staring down a nightmare scenario.
Yeah.
On your left flank, you have a hidden energy import bill shock stemming through the Middle East. That's the 15-country, $4 billion ADB bailout we discussed, driving up your domestic inflation.
Right.
And simultaneously, crashing into your right flank is this sudden, unguided funding shock from Tokyo, making your national debt infinitely more expensive to carry.
And the risk premium, the extra yield investors usually demand to hold risky assets, is completely failing to price in these simultaneous pressures. The market is asleep.
Completely asleep.
We are already seeing the early stages of this dual squeeze paralyzing other regions. Take the Philippines, for example.
Right. Our sources highlight that inflation in the Philippines is holding stubbornly at 6.8%.
Yes. Because of that sticky inflation, their central bank, the BSP, has an interest rate hike looming. When a central bank hikes, it shifts their entire yield curve upward. In plain terms, it becomes more expensive for the Philippine government to borrow money for itself.
Right, which severely squeezes their fiscal space.
Exactly, meaning they have less money for public services, infrastructure, or economic stimulus. And they are facing this domestic squeeze at the exact moment the cost of capital flowing out of Japan is about to spike.
It's like a business owner facing a sudden 30% increase in their supplier costs.
Yeah.
Right on the exact same day the bank unexpectedly calls in their primary line of credit.
Perfect analogy. You are squeezed on both ends.
The dominoes are lined up with terrifying precision, but the market consensus is just staring at a calendar saying, well, the BOJ meeting isn't until Tuesday, so I'm sure it's fine.
Right.
And speaking of how these dominoes connect, there's a detail in our sources that absolutely blew my mind. It involves an infrastructure route called the Middle Corridor.
Oh, this is perhaps the most fascinating geopolitical tripwire in the entire stack of dispatches. The Middle Corridor is a major trans-Caspian trade artery. It's designed to move goods between Asia and Europe while bypassing Russia.
And crucially, the sources note this specific trade route has received backing from former President Trump. And again, we aren't looking at the politics of that endorsement, but rather the viability and the market confidence it injects into the infrastructure itself.
Exactly. We're tracking the market's response to the support.
Right. But the vulnerability here is staggering. Break down the situation in Armenia and how it threatens this entire system.
Okay, so there is an election currently unfolding in Armenia. Geopolitically, the routing and success of the Middle Corridor depend heavily on stable borders and cooperative agreements between the nations in the Caucasus region.
Yeah.
This local Armenian election has effectively become a referendum on whether they will support the expansion and security of that corridor.
Wait, and if the election shifts power to a faction hostile to the corridor?
The physical trade route faces delays, blockages, or complete rerouting. And here's why that matters to global finance.
Yeah, how does this connect?
The transit revenue generated by goods moving through that specific choke point is the very cash flow that underwrites the risk premium on massive infrastructure bonds in places like Kazakhstan and Uzbekistan.
Hold on, I want to make sure I'm wrapping my head around this. If the Armenian election goes sideways, the physical trucks and trains can't get through.
Right.
If the cargo doesn't get through, the transit fees vanish.
Exactly.
And without those transit fees, the multi-billion-dollar infrastructure bonds issued by completely different countries, like Kazakhstan and Uzbekistan, suddenly risk default.
That is the exact mechanism.
That is insane.
The sources refer to this as the connectivity premium, and it is completely absent from consensus risk models.
Wow.
A trader sitting at a desk in New York might be looking at a generalized emerging market ETF, assuming his Kazakh bonds are safe because the global oil price is low.
Right, he's just looking at the ticker.
Exactly. He is completely blind to the fact that a localized domestic election thousands of miles away can literally threaten the underlying value of his portfolio.
It is the ultimate blind spot. The market treats these global trade routes and financial mechanisms as, like, permanent tailwinds.
Yeah, they take them for granted.
They completely ignore the single points of political or logistical failure that hold the entire house of cards together. They ignore a local election in the Caucasus, just like they ignore the single point of failure in Tokyo, the health of one man.
The cheapest mistake an analyst can make right now is waiting for the official headline to tell them what reality is. The headline is always a lagging indicator.
Always.
By the time the calendar event actually occurs, the structural damage beneath the surface has already compounded.
So what does this all mean for you listening right now? The core takeaway from today's deep dive into these sources isn't just about the mechanics of yen carry trades or the intricacies of Caucasian trade routes.
No, it's bigger than that.
Right. It is about the fundamental structural danger of relying on perfect communication and uninterrupted schedules in highly complex systems.
Yes.
We love our calendars. We find immense comfort in predictable schedules and assumed realities. But the map is not the territory. When the veteran guides of the system suddenly disappear, the system doesn't politely pause and wait for them to return.
Not at all.
It reacts, and usually it reacts violently.
Which brings up a critical question for everyone to consider. Think about the complex systems you interact with every day in your own industry, your investment portfolio, or even your corporate supply chain. The global financial market is currently missing the catastrophic risk of a single hospitalization in Tokyo simply because a spreadsheet insists a rate hike is already priced in.
Right.
It makes you wonder, what vital, supposedly priced-in assumptions in your own professional life secretly rely on the perfect, uninterrupted communication and presence of a single individual?
Oh, that's a great question.
What is your plan for when the veteran pilot suddenly steps away and the untested deputy has to pick up the microphone?
That is the exact kind of uncomfortable, brilliant question we love to leave you with. Thank you for joining us on this deep dive into the sources. Stay curious. Keep questioning the consensus, and no matter what the calendar says, always look at who is missing from the room. We'll catch you next time.